How banks make money out of thin air. Banks are as old as 5,000 years. Around about that time is when construction of the Great Pyramids were getting built in Egypt. However, modern day banking as we know it was clarified in the City of London in the 17th century. As we know, banks are places that we go to deposit our money and make transactions and apply for loans. In and of itself, banks are intermediaries. They connect borrowers to lenders. However, it seems as if we've got it all wrong. Economists would say that banks are deposit-taking institutions that lend money. The definition by law is that banks do not take deposits and they do not lend money. Here are three theories on how banks operate with regards to wealth creation and how they make money out of thin air. 1. Financial intermediaries, where they take deposits and somewhere along the lines they make money in doing so. 2. Fractional reserve. Let's say you deposit £10,000. The banks would need to keep 10% of your money in their central bank. Then they would be able to lend it out, and each time taking your 10% and adding on fees, which would compound with the returns from basically doing nothing. For example, let's say the bank lends out 10% they held from your £10,000 deposit and lend it to this guy at 6%. However, they would only pay you interest of 0.2%, thus making money from not doing much at all. 3. Credit creation theory, which is the oldest in banking. This states that banks are not financial intermediaries on an aggregate or individual basis. They do not gather deposits, nor do they lend them out, or keep money stored in excess in their central reserve. Banks are creators in money. When they give out a loan, they are creating new money which is being lent out and added to the money supply. In 2014, Professor Richard Werner published a paper presenting the first empirical study stating, can banks create money out of nothing? In the report, he states that he worked in view of an empirical observation, so they don't have to argue about which theory is correct. The bank didn't draw down any deposits, they didn't move around any precious metals. The reserves were not touched at all. In fact, the £200,000 total deposits increased in his loan amount, which added to the money supply and balance sheet of the bank. So proof that banks create money every time a loan is taken out. Even the Bank of England clarified this. Where does money come from? In the modern economy, most money comes from the form of bank deposits. But how those bank deposits are created is often misunderstood. The principal way in which they are created is through commercial banks making loans. Whenever a bank makes a loan, it creates a deposit in its borrower's bank account, thereby creating new money. This description of how money is created differs from stories found in some economics textbooks. So now you know how banks actually make money out of thin air, whilst you're working your 9 to 5. If you like these kind of videos, be sure to follow.